We learned earlier this morning that home prices rose in 20 cities in November. That's according to the Case-Shiller data. So is this the end of the housing plunge? We are asking Jim O'Sullivan. He's with me now here on set in the Bloomberg newsroom, chief economist at MF Global. Thanks so much, Jim, for coming in. So let's talk about the home prices. And we just got this November data as well. You say the plunge is over?
It would appear so. I mean, you take the numbers literally over the last 6 months, and the Case-Shiller number's up 3.5%. And now even the FHFA number's up a little bit. Should you extrapolate that? Probably not. There have been mixed shifts, which may have distorted the numbers. But you step back, and I think the big picture is that the plunge at least is largely over.
We've sort of seen a three-pronged support system for housing, at least to get it out of the gutter. I mean, we have low rates, so low mortgages, some help from the federal government that first time, and then second round of the first buyer's tax credit. So what if these things begin to slow down? What if rates go higher? I mean, at what point is the timing game going to work out?
Well, part of it depends on what you're left with, even when the extra stimulus from the government fades. In the meantime, it does look like you're starting a self-sustaining recovery where job growth hopefully will turn positive in the next couple of months, and that's certainly important for consumer confidence, which in turn feeds into people's willingness to buy a new home. And I think we're moving in the right direction on those, although it's slow so far. Mortgage rates remain low. Obviously, there's the expectation and the likelihood that the Fed will stop its mortgage-backed securities buying program in a couple of months. But so far, mortgage spreads have stayed tight, and there's no sign of any real disruption to the market there. At some point, of course, the tax credit will expire, but it's been renewed, and that, if anything, should give home sales another lift over the next couple of months.
You mentioned confidence. You were talking about it in relation to housing, but we also got some consumer confidence data as well, a little bit stronger than forecast. To what extent should that be a relief, or is it kind of a one-off?
Oh, it's certainly a plus. Now, they're not strong numbers in any absolute sense, of course, but you're at 50-something on the Conference Board number. You were 20-something early last year. So the numbers are moving up. And if you put it in the context, say, of the retail sales report that came out for December, which, of course, is weaker than expected, I think this is further confirmation that that weakness in retail sales was just payback for exaggerated strength in November. And when you average out the numbers, the trend here seems to be improving still.
Jim, tomorrow, or rather today, the Fed is already in its meeting. Tomorrow we get the announcement. I mean, no one is expecting any kind of change from the 0 to 25 range that we are at now. But what about this idea of setting an interest rate on excess reserves and then just kind of letting Fed funds trade to that? How likely a scenario is that?
I think it's unlikely in tomorrow's statement, certainly. And I mean, that was an interesting article on Bloomberg this morning. It certainly raises the point that there's still a lot of uncertainty on how exactly the Fed will operate in this new environment where they're looking at the balance sheet, not just the level of interest rates. I would make the point that whether they officially target the funds rate as they've done in the past or interest on reserves, the two measures will broadly go up and down together. There'll perhaps be a bit of a spread, hard to say how much, and time will tell how much, but they will go up and down together. But is it possible they could target interest on reserves? It is possible, yes.
Because it seems like they have to have some sort of plan when they want to begin sopping up the liquidity, right? And I mean, this would be a relatively easy way to do it.
Well, again, I would say that they're very much the same decision, whether you're looking at interest on reserves or the federal funds rate. They will go up and down together. They won't be identical, but maybe there'll be a 20 basis point, 30 basis point spread between them. But broadly speaking, when the Fed ultimately decides to raise interest rates, they're going to be raising both the Fed funds rate and interest on reserves. The exact magnitude will differ, but essentially it's the same thing that you're talking about in the end.
Jim, a curiosity question. Are economists talking or buzzing about Bernankes, the fact that his second term, the fact that his first term is coming to a close, looks likely he'll get the second term? Are people talking about that in the inside world of economists?
Well, I mean, certainly the expectation has been that almost certainly he's going to be reconfirmed, but obviously it's being drawn out in the markets a little bit more, and it's being politicized a lot more than I think people would like to see. So have there been some doubts over the past week that it would happen? Certainly more than seemed likely a couple of months ago, but the expectation is still that he's going to be confirmed, and that seems to be on track. But it's been an unnecessary distraction, I would say, in markets over the past week or so.